Please stay tuned after the conclusion of the podcast for additional important information. Hi, everyone. Welcome to Accrued Interest, PIMCO's podcast dedicated to delivering thought-provoking, impactful, and timely investment ideas to financial advisors and their clients. Accrued Interest is part of our Advisor Forum platform, which you can find at www.pimco.com. My name's Greg Hall. I lead our U.S. wealth management business. I'm delighted to be your host today, but I'm even more delighted to welcome Dan Ivascyn to join us for today's pod. Dan is our Group CIO. You might interpret from that title that Dan oversees the entirety of the investment function here at PIMCO, in addition to which he plays a personal leading role on a number of the products that you may know from PIMCO. Many of you will associate him with the Income Fund, which he has stewarded since its inception. He plays a lead role on our Total Return Fund and has been deeply, deeply involved in the development of our alternatives businesses, spanning hedge funds and private markets over the last 20 years or so. He's a busy guy. He's got a lot going on. We're grateful to have him here. There's nobody at PIMCO with greater depth or breadth of experience to help kick off the new year. Welcome, Dan.
Thanks, Greg. Great to be here.
Appreciate you being here. I wanted to start before we get into the meat of the conversation today, just to address something, I think a sentiment that we both share, as does everybody here at PIMCO. I think starting the podcast off for the year, ordinarily we'd be, I think, very joyously wishing everyone a happy new year, and we certainly do hope all of our listeners have a happy, healthy, and prosperous 2025. But this year, of course, it's tempered a little bit by just, I think, some shock and sadness at the devastation of the wildfires up in Los Angeles. Our hearts go out to everybody impacted. We have friends, colleagues, family members who've been impacted. We'll be working as a firm through the PIMCO Foundation, I think many of us individually as well, to help Los Angeles recover and rebuild.
Yeah, you're right there. We are, down here in Orange County, not too far away, and we've been fortunate to avoid a lot of the destruction and challenges, that our neighbors are facing up north. So we fully agree with you. It's been a tough start to the year, and we hope things stabilize as soon as possible.
Yeah, it's a city that's near to us geographically, and of course, dear to us personally. Well, Dan, I was given a very long bio listing your many accomplishments, here at PIMCO, and before arriving, it felt like it might be a little awkward to sit in front of you and read it to you. And I know how fond you are of being praised or lauded in public. You're a pretty humble guy, so I didn't want to do that. I actually thought it'd be a lot more effective if you maybe wanted to introduce yourself a little bit to listeners and give us a sense of how you came to PIMCO, what your journey's been like at the firm.
Yeah, I'll be brief. I could go way back, but I guess I'm a kid from Massachusetts. I came out to the West Coast pretty early in life. Got my undergraduate degree up in Los Angeles.
Yeah.
And then spent some time in the business, but more in a sales and servicing role, always with a passion for fixed income. So I always had an eye towards, coming back in some capacity and actually, making portfolio decisions on behalf of clients, and thought I was headed back to Bear Stearns. I had spent a summer working on and co-authoring a handbook
This was 90s?
This was my 97,
90s?
yeah.
Yeah,
So
okay.
going way back and working on what was really the beginning of the home equity or the subprime market. Working on a research piece then, and it's quite interesting because I thought I was going back to Bear Stearns. Got interviewed very, very late in the recruiting process here at PIMCO, and thought it was a great place to work. We had been
Bear was Bear active in like the ABS market, the asset-backed market back then, with all these high LTV guys? Is that where you'd focused on when you were there?
They were.
Yeah,
They were. I ended up working in the research group, which was closely connected to the investment banking area.
Yeah.
Bear Stearns was a leader in bringing deals to market. It was known as home equity. The home equity market. It was really subprime, or the early days of the subprime market. Although I didn't go back to Bear, I came to PIMCO. We had a very strong trading relationship. So I guess my beginnings were in the asset-backed space. Quite popular nowadays, of course. Asset-backed investing is cool again. Of course, it wasn't so cool during the LTCM crisis in '98, and then of
Yeah.
course the challenges during the global financial crisis.
But what a time to start, right? I mean, the to launch your career into the teeth of yeah, long-term capital, Russia crisis, and the demise of virtually every wholesale financed lender in the home equity space.
Yeah, that's right. And I did a little bit of agency mortgage trading along the way. I remember Bill Powers, who I reported to directly, said to me, "Hey, welcome to PIMCO. We're going to have a nice training program. Take your time. Don't worry about executing trades anytime soon. We want you to build a foundation." And then when the LTCM or long-term capital
Yep.
volatility hit the marketplace, and we were trading far more than we thought, he was throwing paper tickets, down at me. And
This is your first summer at PIMCO? Is
this
that
was my first couple of weeks at
yeah,
PIMCO.
PIMCO? Yeah, yeah,
Literally for
yeah,
the first
yeah.
couple of weeks, and back in the day when you didn't have the luxury of computer execution, you had to hit your phone 8 times, call 8 dealers, lights would flash, then you get your levels back, and you're supposed to sell to the highest bid and buy at the cheapest offer level.
Yep.
Sounds good in
Oh, was it good?
theory.
Yep, yep, yep,
Easier said than done when you
yep.
have the flashy lights. You have to do it quickly, and the market's moving around. So it
Sure.
was trial by fire. But that's really been PIMCO. It's always been a fairly lean organization, a flat organization. You tend to get involved quickly, trial by fire, but also learning by doing. And operated in this asset-backed and mortgage space early on in my career, and then as a lot of us do, just steadily take on more responsibilities, broaden out your areas of
Mm.
focus, but still you know a an asset-backed trader at heart, but of course have migrated into other areas of the market looking for value for our clients.
You had your 25th anniversary at the firm. It feels like last month, but it was 18 months ago, a
Yeah.
couple years ago. Yeah, yeah. So 25 plus years into it, I would imagine you still feel like, new skills, new areas of study, new people to learn from.
Yeah, absolutely. I think you feel the same way.
Yeah,
What's so great about this industry is that just when you may think you're about to figure it out, the macro environment changes. Something new, hits the marketplace that you have to react to. So, even today, we have a new administration, new
yeah,
priorities, regulatory regimes change, valuations change. So that's what's so great is that you never have it fully figured out. And if you think you have, you better stop and pause and realize you probably don't. But it makes it really exciting, and it's especially exciting in an environment like today where there's so many other forces at work that the younger generation understands far better than folks like
yeah,
myself. So
yeah.
it's always exciting because you have to listen a lot, get to know different perspectives, and then just get out there and explore. It's fun in that regard.
One of the things, though, just as we're sort of rounding out um, people's awareness or familiarity with you, that I think maybe is not as obvious to a lot of our listeners. Maybe some of them have had the fortune of joining us here in Newport for a conference, or you've been out and about. You travel a lot. You see, a lot of our clients, but you speak to a lot of financial advisors. And I know that obviously I appreciate that in the business that I lead. You make a real point of getting out there and talking to people one on one. You're famous for shooting an email over to me and to Phil Neugebauer, our head of strategy, looking for half a dozen names of people you can call on a Friday afternoon just to check in, say thank you, see what's on their minds. What drives that impulse for you? What do you glean from those conversations?
I'm not sure. And again, I started as a financial advisor,
Right.
so maybe there's some connectivity there. But it's really great just to compare notes, to hear what people are seeing and thinking about markets, meeting people with different perspectives, different areas of focus than where I'm typically operating, and it's just good to connect on the human side. I wish I had more time to do it. As you know, I sometimes get backed up, but it's always a great way to connect to the end client and hear directly from
Yeah.
the mouths of people that are serving a very important role on what we could be doing better, other thoughts, perspectives, contrarian viewpoints, credible ideas from others in the industry that may be different than our own.
Yeah. The experience that those conversations often they bring with them I think it's invaluable, right? These are people who've seen cycles, and their pattern recognition and sense of like we've seen this movie before is incredibly valuable.
Yeah, absolutely
I
agree.
know you value that too,
Yeah.
even here at PIMCO. Let us move on to what I think most of the advisors listening are probably most interested in this conversation, which is what is Dan Ivascyn's outlook for 2025? We just published our cyclical outlook. Uncertainty is certain, which I think is a brutally honest title about where we think markets stand in 2025. I'll give you the mic, wherever you see fit. Let's get into the outlook.
Yeah, let me hit a few points.
Yeah.
And it may sound a little bit like a cop out, but the good news is you don't need a precise outlook, at least within the fixed income markets. And what I mean by that is that there's a tremendous valuation cushion that's built up into the higher quality areas of the bond market. Now, it's been painful because as that valuation cushion is built, it's meant negative returns in a really, really volatile 2022.
Yeah.
But starting yields are attractive. They're attractive in a nominal sense. They're attractive relative to a still elevated inflation rate. They're attractive relative to their history. They're attractive versus equities and cash. So I think it's important to note as an allocator of capital that with good initial conditions, the prospects for returns over a multi-year basis are quite attractive. And I say multi-year because I think most advisors, on or listening to this podcast, have clients that do have a multi-year time horizon.
Mm-hmm.
So yeah, there's going to be a lot of noise, and that was our whole point with the cyclical outlook. Got a lot of uncertainty. Trump administration priorities. What does the Fed do? What do other central banks do? Geopolitical risks. They're elevated. But the great news, again, is that if you're patient in the high quality fixed income markets, unlike other sectors, you earn your yield. There's about a 95% correlation between the starting yield and the return you're going to get over a 5-year basis.
Right.
And today, in some of the higher quality strategies that we focus on, you may get a starting yield in the 6-7% range. So I think that's point number one.
Okay.
In terms of the specific outlook, we're fairly optimistic. We think that there's a good chance that earnings hold up. Yeah, there's more uncertainty outside the United States. You have less technological innovation, a less vibrant consumer sector across many of the economies within Europe, the UK.
Mm-hmm.
Obviously, China's going through a period of disinflationary pressure and a lot of growth uncertainty. Now, this is great for active asset management.
Sure.
Less synchronized cycles, a lot of localized volatility, a lot of room to express relative value views and not just put all your chips down, so to speak, on one
Right.
singular directional view.
So much lost in the index relative to the opportunities you're describing.
Absolutely right.
Yeah,
And then
yeah,
you're going to say, okay, well, we're PIMCO, we're a global active asset manager. What would you expect me to say? But, I think 2 points there. One, a few years ago, late 21 as an example, strategies like our income strategy had our all-time lowest interest rate exposure. We tended to be very concentrated in the United States because although rates were low here, they were negative in many other parts of the world. So today, when you look at our positioning, when you look at our activity, we are taking advantage of a global opportunity set. We're able to add value outside of these passive indices that aren't particularly interesting or exciting the way that they're constructed today.
Yeah.
So we're generally optimistic. But back to the outlook. Again, we do think in the base case growth is going to remain strong in the U.S. We think that the Fed is going to look to cut rates once or twice this year, but for the time being, they're going to be on hold. Inflation's elevated. There's still plenty of uncertainty regarding Trump policies. So I think the base case thinking is that we're going to continue to have elevated short rates, but short rates now that are comfortably below the rates you could achieve in an intermediate bond portfolio.
Can I ask, just let's pause 1 second. That last point that you made, I want to make sure, you'll probably remember a few months ago when Rich Clarida, our global economic advisor and former Fed vice chair who works with us here at PIMCO now, he sent an email around, and I think it was titled "Stop the Presses," because the front rate had dipped below the ag yield for the first time in a couple of years. You'll know better than me, and I'm not sure that people have a strong enough sense of just how weird of an environment or how long that weird environment had persisted. And maybe you could just give some life to that.
Well, yeah, it was an exciting day for us from a business perspective.
Yeah,
As
yeah.
you can relate,
To-
being
com-
in your role.
Finally had an argument relative to cash. That is true.
And it's important though. I joked around that my mood moved inversely with the 10-year Treasury rate during 2022,
Yeah,
and
I can vouch for that.
those that yeah, as you know, those that
Yeah.
had interacted with me knew that that was the case. But I think it's been a very unique multi-year environment where the cash rate's been above the interest rate you could achieve in a longer maturity bond portfolio.
Yeah.
This goes back to this cushion point that we talked about earlier. When you have that type of situation, you have to pay to take duration risk. And we remained in that environment for an extended period of time. With the cuts that have occurred thus far with our central bank, the Federal Reserve, and then other central banks as well bringing policy rates down, now you have a much steeper yield curve. You can actually pick up significant incremental return or expected return or yield by extending out the maturity spectrum.
Yeah.
So that's point number one. And I know it's easier said than done. It's been a bumpy journey, but you have a situation today where the cash rate's lower than longer maturity bonds and where inflation's back down to a point where it's close enough to central bank targets that there are plenty of scenarios where there are negative growth shocks, other surprises that negatively impact other areas of a household's portfolio that could lead to cash rates coming down even faster than is currently anticipated. Or
Right.
put more simplistically, you now pick up a yield advantage and you benefit from the insurance that a high quality fixed income portfolio provides.
Yeah, I think a lot of advisors are like, literally right now are going through the analysis. They have held cash very intelligently over the last few years as the insurance policy, the ballast in the portfolio. It's paying a nice high yield. If you extend it out and picked up duration, you had to pay for it, like you just said. But now you get paid to extend duration. And just to make this overly simplistic, in the event of an economic downturn or some kind of economic event, we would think that bonds play their kind of traditional role in the portfolio of insulating, of having positive total return when you see that economic event. So in effect, you're being paid to take out an insurance policy by venturing out of cash and into fixed income. Am I being too simplistic there, or?
No, I think you hit it right. I think the other point, to emphasize is that back a few years ago, when your starting yield was 1 or 2%,
Right.
it took a very small interest rate move to put you into negative return territory. Today, if you're starting with a 6 or 7% return in your portfolio and you have a few years duration, you can have a meaningful sell-off in the market and still end up with a positive return. So there's this cushion again. And I know a lot of us are conditioned, and I'm a big fan of the behavioral finance literature.
Yeah.
I think it's a key way to make more objective decisions than others in the market, avoid the tendencies to do irrational things, and in the process make money for investors. But there's this concept of recency bias,
Right.
and 2022 was a rough period. We've had volatility over the last couple of years, including a pretty significant sell-off the last few months. So, we'd like to see more bearish sentiment in the market. And today, I think I can safely categorize this as a market where people are still pretty bulled up on equities.
Yeah.
They've had an incredibly positive experience in more economically sensitive or lower quality credit risk. Private markets,
Yeah.
not surprisingly, in this environment where duration has performed so poorly, particularly floating rate credit risk, are areas that continue to get a lot of inflows. And there's probably a little bit of complacency in those markets. So from a sentiment perspective, I think you're in the right place in terms of a fixed income allocation. And it's really, really great to see a setup where you got really attractive valuations and you still have this negative sentiment in the markets. That's usually a recipe for pretty good returns and sometimes surprisingly good returns on a go-forward basis.
One of the things I wrote down as I was preparing for this over the last couple of days um, it seems to me like with the quote unquote the Trump trade and the sort of animal spirits that's introduced into markets, it feels like all the optimism is reflected in the equity markets and all the pessimism is reflected in the fixed income markets. And at some point, those two would seem to need to resolve themselves.
At some point,
Yeah,
absolutely right. And just a couple of days ago, it was the widest gap that we had seen in several decades between the multiple, um, here in the United States equity market versus the real or the inflation adjusted
right,
yield in the fixed income market. Now, again, it does not mean that these have to mean revert or adjust very, very quickly.
right.
But back to the original point, within fixed income, you get paid while you wait.
Yeah.
You're earning this yield, and then at some point in time in the future, you may get some price appreciation as well. It could go the other way, of course, over the short term. But we do think that the setup is increasingly attractive to be able to generate some additional incremental return from some price performance as well.
And would you agree? I mean, I would, if I were speaking to a financial advisor now or to one of their clients, I'd emphasize that a constructive view on equities can peacefully coexist with a constructive view on fixed income. And in fact, if you're bullish equities and you think that's where you want the majority of your portfolio placed, might be a really opportune time to add to your fixed income portfolio and insure some of that tail risk as you pursue those equity returns that you're predicting.
Yeah, I would agree with that. And I would also add that as inflation becomes less of a concern, or to the degree it becomes less of a concern, maybe I'll qualify it a bit. Having more fixed income in one's portfolio can allow you to own more equity risk. We talk about these risk
Right,
parity
right,
strategies, and, and,
right.
and it's a more of a technical point. But when you think about the optimal asset allocation, you can get to a point where those bonds, provide some volatility mitigation and are a better, more robust setup than having excess cash as well. But these are things that we can run on behalf of clients. They involve certain assumptions. But I think the point is in 2022, when inflation was near double digit levels, those were quite strained arguments, especially with a starting yield of 1 or 2% in the bond market.
Right,
When you look at where you are
right.
today, and you look especially at times where you've had a similar setup in the market in terms of relative valuations, cash equities and bonds, we think it bodes well for returns by adding a little bit of fixed income to an existing allocation.
Yeah, and I should take the opportunity to plug. We have an analytical tool called PIMCO Pro where we can do exactly that on behalf of clients, is help them analyze the optimization of their portfolio, or at least the potential optimization of their portfolio. And it's a great point you're making. I hadn't really thought about it in those terms, but you can free up risk capacity to express an equity position if you've got some downside hedging, if you will, through the fixed income portfolio, which cash simply just by its nature doesn't provide. It's really interesting. You mentioned private markets, and when we talk about portfolio allocation, in the wealth management space, less so in the institutional space, but really the notion of a private market allocation of any significance for the vast majority of wealth investors, that's a relatively new concept to add to your portfolio optimization. And there is a lot of product out there. There's a lot of money being raised in private strategies in the wealth space. I am curious to what extent you think that recency bias you mentioned, the trailing track record, the floating rate exposures in a rising rate environment, how excited or cautious ought individual investors to be with this new option that's placed in front of them?
Yeah, well, there's a lot there. I probably
Yeah,
should have
yeah,
mentioned this earlier.
sorry.
No, no,
Yeah,
it's a
yeah.
great. We could spend a long time. This is a very interesting area of the market. I should have mentioned this earlier. I was trading private assets and private placements for PIMCO when I first joined the firm. Back in '98, used to focus on commercial mortgages. These RTC private placements. That you know were created during or coming out of the savings and
Yeah,
loan
sure, of
crisis.
course, of course.
So I think the key point here is that you know, private markets are less liquid than public markets. They're an important part of the opportunity set, and there's all different types of flavors of risk. So I think it makes sense in a diversified portfolio to have some exposure to public markets, some exposure to private markets, though realize at times when spreads are tight in general and credit spreads are near historical tights at the moment, you tend to get less compensation for giving up liquidity and moving into the private markets.
Right.
Also, I think it's important to note because certain segments of the private markets, or actually most segments of the credit markets, period, have performed so well,
Yep.
you have a lot of money pouring into those areas.
Yep.
And what
Yep.
that's leading to is a bit of a supply demand imbalance, which is leading to even more compressed spreads in the private markets or weaker document protection than you'd like. Now,
Right.
that's a bigger concern in the lower quality areas of the market, the areas of the market that are going to be much more economically sensitive in terms of ongoing performance. And I think also when you look at lower quality, more levered companies, these are the types of companies that are being disrupted by all this technological innovation and resulting uncertainty.
Right.
So, being nimble, being able to make active investment decisions is still pretty darn important. My old, colleague and mentor Scott Simon used to tell me, don't give up.
Scott, he managed the
Scott
mortgage
Simon was a
desk
mortgage
here. Yeah.
desk,
Yeah.
yeah,
Yeah.
and he'd
Yeah.
say, a lot of, you know, perhaps overly simplistic sort of rules of thumb that I still think about today. Just don't make it more complicated than it needs to be.
Right.
Make sure if you're giving up liquidity, you're not just giving it up for the sake of giving it up, that you're getting paid to take that risk. And there's certain areas of the market that we think make sense. There's certain deals, in the context of markets that are becoming increasingly crowded, that still makes sense. And I think the bottom line in general, anytime you're talking about the more economically sensitive areas of the market, you want to be a little bit cautious, a little bit more selective today than you would a year or two ago when you had a lot more spread compensation.
Yeah.
Um,
I think I worry sometimes that the narrative is so good. The banks have pulled back after the financial crisis. There was for a time, and may still be, a very legitimate gap in funding available to those companies that you're talking to. There was a gap in funding available to private equity sponsors, but the notion of private origination, you just made the point, right? You were doing it in 1998. It's not a new concept. It's just it's never been at this scale before, and to a degree, it's somewhat untested through a cycle because it's mostly an innovation of the last 10 years.
yes, and I think also though it's important to note that we have been in highly favorable.
Right.
We've been in a highly favorable environment for credit risk and equity risk in general. It's quite remarkable. There's a chart we had at our recent client conference. I didn't believe it was true when I first saw it, and I should have. But it went back and looked at returns within the deeper, the lower quality credit markets, going all the way back to the launch of the high yield market in the early 80s.
Yeah.
And basically,
Yeah.
what the chart said was that you had periods where you generated pretty attractive returns in those segments of the market, public or private. And then you'd have an event, and you'd give back, multiple years of incremental return. But the bottom line is, going back from the early 80s to 2008, as an example, you didn't get paid a lot over that multi-decade period for taking lower quality credit risk.
Right.
If you look at 2009 to the present, it's been almost a one-way train
Right.
where investors got paid
Lower quality being like high yield,
outperforming
leveraged
lower quality.
loans,
Yeah,
and the middle market private credit, sponsor lending. Am I interpreting you? I don't want to.
yeah, no, you got
Yeah.
it
Yeah. Yeah. Yeah.
perfectly right. And then I think another important point is that during the global financial crisis, it was asset-backed lending, mortgage lending,
Right.
excessive risk-taking from the banks that caused a lot of the problems, literally across the global economy. And as people have probably heard me say repeatedly, regulators hate bailing out the same sectors twice.
Yeah.
So you've had a situation where, of
Yeah.
course, there's been an aggressive regulatory response to lending against the home, consumer lending, other forms of asset-backed lending, because they did cause all the problems, back during the GFC. Then a lot of regulation of the banks. The non-financial, lower quality corporate sectors avoided that regulatory scrutiny. So perhaps
Right.
not surprisingly, when you look on the chart, the growth, you've had one segment of the market grow, or not much at all, even shrink in real terms.
Yeah.
You've had this massive growth in the senior secured loan space, in what we call now the mid-market lending arena.
Yeah.
And again, I think because of that growth and because of some of the market share battles going on in that space, you have a little bit of complacency there. At a
Yeah.
minimum, it's the least interesting area of the credit markets.
Yeah.
And we think one of the most obvious asset allocation decisions advisors can make on behalf of clients is to target those areas that have arguably been overregulated, that benefit from strong fundamentals, strong investor protections. In a go-go economy where earnings are growing significantly, it's very hard for an investor to tell the difference between more resilient areas of the market and the less resilient areas.
Uh-huh.
We are super confident that when you have a negative economic shock, when you have a recession in the future, you're going to see a meaningful performance gap. So it's not so much private's bad, public's good. It's really a situation where you have to look at the subsectors of the market, look at these deals in great detail, and just acknowledge and realize that it's a frothy underwriting environment. Do your good old-fashioned credit work, and you can put together a diversified portfolio. And again, an area of conviction of ours is still focused on the asset-backed space, lend to the consumer that has so much equity trapped in their property, and resist the temptation of being too aggressive in the mid-market, lower quality lending space.
And importantly, you feel like that both in public and private. It's about the underlying asset quality. It's not about the form of lending that we're doing, whether we're doing it in a bond or in a private loan.
That's right, and I think in addition to the words that we'll share today, if you look at our diversified portfolio, so
Yes.
we have strategies that focus on public markets, we have strategies focusing on private markets, and then we have strategies that have a broad opportunity set where we can do both.
Yeah.
Everything I just said in terms of our asset allocation preferences are quite consistent, whether you're talking about our public daily liquidity strategies or other forms of semi-liquid vehicles, permanent capital vehicles.
Yeah.
We have a consistency and a very, very high degree of conviction and are positioned accordingly on behalf of clients. Look, as I mentioned before, if this economy continues to grow at 2+%, if we continue to have significant earnings growth and stocks continue to perform well, it won't matter.
Yeah.
If you do have some type of negative growth shock, negative earnings shock, investors will see the difference, and we think it's a really, really obvious asset allocation decision that clients can make today. Happy to talk about obviously in a lot more detail on follow-up.
Yeah,
as well.
of course. One thing maybe just as a last question on this point that I struggle to articulate. I've been working on it. I bet you can do it a lot better than I can, but I do feel like there are areas of whether it's the private credit market or just the equity markets generally that are far more predicated on this need for rates to come down quickly in order for them to achieve what they've set out to achieve. If you did a lot of private real estate deals going back several years ago and you want to achieve a return based on where you underwrote them, if you're betting on a tech company and cash flows way out, into the future, you're far more sensitive to the outlook for rates. And then I look at what we do in the core of our business, and I think, well, if we're higher for longer, like you said earlier we're fine. We will continue to collect a great, attractive rate of return. We'll achieve hopefully our own goals. But it does seem to me that there's parts of the economy and parts of the investment landscape that are far more levered to a very quick Fed move downward than we are right now.
Well, that's right, and I think this is very true of the floating rate credit markets in general, both corporate and commercial real estate lending markets.
Right.
A big stock of this issuance occurred when policy rates were near zero, and we've had a massive rate shock. And they're more fragile or sensitive areas of the commercial real estate markets or the lower quality direct lending markets where borrowers have taken out floating rate debt. They're not well hedged versus rates, and they were counting on rates coming down a lot more than they're probably going to come down. Now, again, if you combine elevated rates because of higher and lingering inflation with some economic weakness, you're going to see problems develop in those sectors. And, we, across a lot of our strategies, stand poised and ready to take advantage of those periods of stress and are doing so currently. You see it on a global basis. As an example, the United States has a very unique mortgage market. Fixed rate, but fixed rate for 30 years.
Yeah, sure.
Very uncommon in a global context. Most other economies have consumer lending markets that are mostly floating rate in nature. And you see the U.S. consumer, U.S. households holding up much better than the rest of the world. A little bit harder to see, and these can be masked through extensions and other asset management techniques, but you have similar signs of subtle or not so subtle stress within commercial real estate, within the direct lending markets. So it's not like as if there's a catastrophe around the corner, but there is strain and stress that you don't see in the fixed rate lending markets where companies have locked in very low rates for extended periods of
Yeah.
time, where
Yeah.
you haven't seen the rapid growth and where underwriting standards have stayed much more solid. So this is a very, very subtle dynamic in the market today. It's a little bit masked by the strong historical performance, but it gets back to this fairly obvious asset allocation decision that clients can make, where you hope you don't need the resiliency. We hope that the economy remains strong. We hope that there aren't negative growth shocks of a geopolitical nature. We hope equities continue to go up,
Yeah. Yeah.
but sometimes they don't.
Yeah.
And I think this is the unique
Yeah.
opportunity in the current environment where you can maintain an attractive base case return and protect the were to sum up what my job is as a CIO and what our job is collectively at PIMCO, is it's to provide attractive returns with appropriate resiliency and downside protection. And the exciting part is that, yeah, there's plenty of uncertainty. We talked about it in our recent cyclical outlook, but valuations are attractive and there's all this, localized volatility and opportunity to do, really smart things on behalf of investors. And again, create not only an attractive base case return, but a resilient profile as well.
Speaking of uncertainty, we are, I think, 2 days past Inauguration Day. There's obviously been a flurry of news and actions and executive orders. You mentioned earlier we've got a base case of a soft landing with some fat tails or fatter tails to either side of it. Anything you've seen in the last few days that makes you think that we could be in for more volatility than we'd prejudged or less volatility?
Yeah, it's early, and
Yeah.
I think an important point is, although we have a constructive view on the economy, we think that there's a decent chance we achieve a soft landing. That's mostly priced in to
Right.
markets. So, me saying that should not just be an all clear sign to take lots of risks, because there's a lot of inherent optimism in terms of volatility. We've had a bit of a relief rally. Early signs from the administration are that. They may take a more measured approach to tariffs.
Mm-hmm.
They may, and I think, in a higher level sense, be willing to calibrate their policy over the short term to market signals or signals from central banks, as another example. But this is going to be a big source of uncertainty. You have a very, very unique situation where the economy is quite strong. Inflation's above central bank targets. The Fed's trying to engineer a slight slowdown to achieve that soft landing, which is in reach. And you have a set of Trump policies that may be great for growth over the long term,
Mm-hmm.
but could lead to further overheating over the short term. So again, there's this very, very difficult situation for policymakers now, where what may be good over a multi-year basis may not be so good over the short term. And we as market participants are really, really focusing on the administration's willingness to calibrate policy to some degree to try to avoid the Fed having to come back into play, to avoid some risks of higher long-term interest rates, which can quickly migrate into some problems for equity markets, commercial real estate markets, private lending
Yeah.
markets as well. So, the administration, has a lot of, really good economic resources there, but we're spending a lot of time, and I know others in the industry are spending a lot of time focusing on policy prioritization, willingness to calibrate. So we don't know for sure, but
Yeah.
I want to, probably go back to the main point, relative to when the Fed has started cutting short-term rates. Longer-term interest rates are almost 100 basis points higher.
Yeah.
So there's this cushion. You don't need to get it all right. We can live
Yeah.
with some volatility. We can live with some more aggressive tariff activity.
I think
as
I don't mean to
well.
interrupt. I'm sorry, but I also think that again, observing you, from my seat, we've been capitalizing on volatility. One of the questions we get from advisors kind of frequently is, just given our size, are we nimble enough? Do we have the liquidity we need to actually express views? And I know you take a long-term view, and you're not tied to your Bloomberg every day. But have you felt any constraints in moving portfolios around to adapt to the ever-changing conditions we see?
Yeah, so short answer, no.
Okay.
But maybe let me comment on the market
Yeah.
side, because there are these narratives that are a little bit crazy that are going around, that there's no liquidity back in the public bond
Yeah.
markets. I've been pleased that there have been some independent media reports, and we do our own work, and we trade these markets every day.
Yeah.
Public markets haven't been this liquid in a very long time. a lot of this is the ETFs, ETF flows, portfolio trading that makes it quite easy to express views.
Right.
We also like the fact that there are more and more ETFs that disclose what they're doing to us every single day.
Right.
Many of them are rules-based. They buy a particular option, they sell an option, they buy a particular bond on a certain date and time,
Right.
and we can watch it in real time. It gives us a lot of opportunity to trade around these strategies that don't make relative value views. They just do what they say they're going to do on the same day,
Yeah.
or they do things and they telegraph it in the marketplace. So not only is the transactional liquidity good, there's a lot of structural inefficiency in markets to exploit. So that's point one.
Yeah.
Point
Yeah.
two, it's great to be large. And I've said this for many, many years. And I don't know how I would plot it on the graph precisely, but we have a strong sense that it's good to be really, really small or really, really big. A bit more challenging to be mid-sized. But what we try to do, given our size, given the size of some of our strategies, is to leverage that. Find ways to source unique opportunities, be able to provide comprehensive solutions to the sellers of risk, be able to drive transaction volume in a customized fashion to create value for our clients, retain asset management decisions, obtain control. One of the big challenges we have in a covenant-light world is that no one has control.
Yeah.
Actually, the borrower
Yeah.
has a lot more control
Yeah.
than the lender.
Yeah.
And size allows you to leverage that dynamic and benefit the investor. And then last but not least, we came out of a period pre-COVID where you had massive global volatility suppression from policymakers. They were expanding balance sheet. They were providing accommodation wherever possible to suppress volatility. Today, exact opposite's true. Deglobalization themes, central banks retracting liquidity or at least reducing balance sheet. You're back to a time that resembles when I started in this business more, where markets have to stand on their own.
Mm-hmm.
The so-called bond vigilantes get paid to make
Yeah.
relative decisions. And when you look at performance across our active strategies the last few years, whether you're talking about hedge funds, traditional mutual funds, or other vehicles, it's been very target rich, and we expect that to continue. And what's nice about that is that you don't have to place big bets on duration or yield curve. You don't have to have all of your interest rate risk here in the United States, where deficits are a bit concerning.
Yeah.
Not overly alarming,
Yeah.
given the United States global reserve currency status. But the great thing about the market today is that you can go and invest at even yield in certain parts of the world that have a very, very strong fiscal picture.
Yeah.
Australia, as an
Yeah.
example,
Yeah.
even the UK, although volatile, looks quite interesting as a diversifier. So this is a pretty exciting time for
I think
active
I've heard
management.
you say, happy to lend to the U.S. government with a 5-year, 10-year time horizon, 20, 30 years, exacts
Yeah.
a different price, right? And I think that's very much in keeping. There's a lot of advisors out there who are very concerned about debt and deficits, and I'm conscious of time, and we've got
Yeah.
Rich next month, and so we
Yeah.
can tackle that with him. We talked a little bit about it with Libby Cantrell a couple of months ago. But do you in terms of kind of your duration posturing at this point, maybe we can end on this.
Yeah.
How are you thinking about rate exposure in portfolios?
Yeah, a few points. One, there's much better value back in the market. So, we have a bit more interest rate risk today. In some of our strategies, we're a little bit overweight interest rate exposure. In more flexible strategies, we're still defensive, but more constructive
Mhm.
on rate risk in general. U.S. deficits are high. They can't stay this high without the government needing to pay more and more to borrow, at least over the longer term. But we also think that the United States government has time on their side, and it's not all negative.
Mhm.
I know people focus on, wow, deficits are high. Is there a crisis around the corner? We don't think so, but also because deficits are high, we get to lend money to the U.S. government at a much higher rate than we would otherwise. So the term premium or intermediate rates are higher than they would have been. And then back in those days when deficits were much lower and inflation was much lower, yields were super, super low. So
Mhm.
we do think that although the government has been less responsible than they should be, it allows us as high quality bond investors to extract higher
Right.
yield. So
Right.
I think that's the second point. Then the last point is just this concept of global diversification. Even without taking currency exposure today, you don't have to solely own the United States. You don't have to extend out into 30-year maturities. You can stay in shorter maturities here in the United States, and you can buy some high-quality interest rate exposure across the rest of the world, high-quality developed markets, emerging markets, and that's exactly what we've been doing across our total return portfolios, income portfolios, global
Hmm.
portfolios. So again, we're not the only game in town. Advice for policymakers is that if they want to continue to be able to borrow at relatively low real interest rates, they're going to have to address this deficit picture at
Yeah.
some point, because we will continue to shift our exposure into some higher quality markets, or markets, with a much more sound fiscal picture. And we're not alone, of course,
Yeah.
in that overall thinking.
All right. There are so many things that we didn't get to, but I do think your time and attention is probably required elsewhere. And maybe if you're up to it, we'll ask you back for a mid-year check-in on some of these topics, because this was fabulous. We really appreciate it. I think advisors will get a lot out of it. And you know this, but this is a time of year. I think it's so important. They're out talking to their clients. They're making their plans for the year. We want to arm them with as many salient thoughts as we possibly can to help them, make these tough decisions in volatile times. So, Dan, thanks so much for your time. Thanks everybody for joining us. And with that, we'll let you go.
Great. Thanks, Greg. Happy New Year to everyone. And again, please share feedback. And again, excited to have, more direct conversations throughout the year with everyone. But it's great to spend some time with you today.
Excellent.
Appreciate it. Thank you.
All right. So that was Dan Ivascyn, Group CIO. Terrific conversation spanning a lot of different topics. A few things we didn't even get to, and we'll tackle in future episodes. If you want to dive a little bit deeper with Dan on some of his experiences at PIMCO, his experiences in markets, the culture here, the investment process here, really excellent conversation he had with Anna Marshall, CIO of the Hewlett Foundation, on the Capital Allocators podcast run by our friend Ted Seides. That was in the summer of 2023, if I'm not mistaken. We'll link to it in the show notes, but that's a great exploration of, I think, a lot of the processes and ways of thinking that make Dan special and make PIMCO special. With uncertainty being certain per our cyclical outlook, terrific time for us to stay in close communication with you, and for you to stay in close communication with your clients. So please reach out to us with any questions or needs that we can be helpful with as you formulate your 2025 plans. As I may have mentioned earlier in the podcast, next month we will be welcoming former Vice Chair of the Federal Reserve, Rich Clarida. He's a global economic advisor to PIMCO. He runs our investment forum process, and we'll do a deep dive with him on Fed policy and the outlook for rates in the United States and abroad. I also wanted to note that we're cooking up some new ideas for pod episodes on specific topics and threads that'll occur in addition to this monthly episode that we do. We'll let you know more about those as they take shape over the course of the year. As always, please visit us at pimco.com for a wealth of information on the topics we've discussed today, and quite a bit more. If you identify yourself there as a financial advisor, you'll be taken to our advisor forum site, which is specifically geared to the FA community. Thanks so much, and see you soon.
The discussion and content provided within this podcast is intended for informational purposes only and may not be appropriate for all investors. Reliance upon information provided in a podcast is at the sole responsibility of the listener. The information included herein is not based on any particularized financial situation or need and is not intended to be and should not be construed as a forecast, research, investment advice, or a recommendation for any specific PIMCO or other security, strategy, product, or service. Past performance is not a guarantee of future results. All investments contain risk and may lose value. Investors should speak to their financial advisors regarding the investment mix that may be right for them based on their financial situation and investment objective. Podcasts may involve discussions with non-PIMCO personnel, and such content contain the current opinions of the speaker, but not necessarily those of PIMCO. Other podcasts may consist of audio recording of an existing PIMCO article, and such material contains the current opinions of the manager. The opinions expressed in all podcasts are subject to change without notice. Information contained herein has been obtained from sources believed to be reliable, but not guaranteed. PIMCO, as a general matter, provides services to qualified institutions, financial intermediaries, and institutional investors. This is not an offer to any person in any jurisdiction where unlawful or unauthorized. For additional important information, go to www.pimco.com/gbl/en/general/legal pages/podcast disclosures.